I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to the show, Mike.
Oh, thanks for having me. It's always great to talk with you.
Some people have asked me, what has the reaction of the markets been to the attacks in Paris?
Well, that's really interesting because going into this weekend, on Sunday night, I was looking on the internet, just seeing what people were saying, and I saw Facebook posts where people were worried the market was going to fall really bad, and there was actually a news story on the front page of Yahoo Finance Sunday night suggesting that the stock market was actually going to drop, and as we all know, it actually went up Monday. So I guess an interesting question would be, why? Why did the market go up instead of down? And there's two reasons. The second reason is actually really important. But the first reason is that the terrorist attacks were terrible. A lot of people died, 120 some, I think it is. But when we see this on television, it is very shocking and troubling, and the way the media is today, it tends to find an event and just really talk about it nonstop for 24 hours or 48 hours, and that certainly was an event that they could do that with. But the reality is that what happens is that gives you the perception that it is terrible that people died, but it gives you a misperception that this event is bigger and more important than it really is. And I say that because this wasn't the first time there's been a terrorist attack in Europe, or even one of this size, either. During this war on terror, there's the bombings in England and Spain, and there is an attack almost identical to this, actually, that took place in India about 7 years ago, where people just used guns and they snuck in the country. I think they did it on little boats, and then they just shot over 150 people. I think it was over 200 even. It was almost completely identical to what happened to Paris. And the thing is, none of these other terrorist attacks, except for the one on September 11th, caused the stock market to drop. Because they just, don't have that much of an economic impact, and they're not going to cause you or me or anyone listening to, be so scared that we're not going to leave our house or do, what we usually do. So that's just the way it is. And so the stock market really didn't care. But another reason why it went up, which is important in terms of the stock market, is that going into this Monday, the market had actually been sliding almost since the very beginning of the month, almost every single day. It topped out after the big rally in October, and it fell fairly quickly without any real bounce. And with my indicators, which are very simple, just use the daily stochastics on the chart, which gives you an oversold, overbought reading. The market was oversold going into Monday. Anyway, I'm speaking of the U.S. stock market averages. And, the S&P closed around 2020, it had given up about a third of the move that began in October, a third of the rally, which that tends to be a support level too. So I just think the market was due to have some sort of a bounce and rally anyway, and now it's obviously taking place and continuing as we're speaking today. And it's funny, these short-term moves are what captures everyone's attention. It's what your brain focuses on, you know. So as we speak, the Dow's up 175, and it's been up this week. And it's easy to forget that it fell last week just about every single day. So now everyone is focused on, well, it's going up. And they remember the big move in October, so people have this sense that, well, the market can just take off now, and it's back to being excited again and just pile in. And I think actually something, just as the market fell this month, got oversold and bounced, I think it's going to get overbought and then drop down again. I don't think we're going to see this giant end-of-the-year rally or this big explosion to new highs and beyond or anything like that. Instead, I think we're going to just top out again and probably lower than the previous high of October even, and just have a drop into December. So I'm kind of looking for the market to be okay, trade with an upward bias a little bit more, maybe go to 2090 on the S&P 500 by Thanksgiving. But I think in December, by then it'll be complete and overbought, and it'll probably decline the first half of December at least into the Fed meeting. And in fact, I wouldn't be surprised if the S&P 500 doesn't fall below 2,000 or something. So I think that's what we're seeing are these short-term gyrations, and that's about it, which will end up leading to more declines to come, like what could, you know, not like in 4 days like we saw in August, but eventually a decline that'll go on for weeks instead of just a couple days. Because I think this is still a real bear market.
How are the stock markets going to do in the new year?
Well, if I'm correct in assuming that the market will have a pullback in the first half of December, there'll probably be some sort of bounce into the new year. Usually the last 2 weeks of the year and Thanksgiving week too tend to be historically the most likelihood of an up week. So I would look for that to happen, but I really think that next year is probably going to be a bad one for the stock market. And the reason why is I think we're actually in a bear market now that started really way back in July when the market made its ultimate peak for the year. It did rally in October, but it failed to make a new high. And I just think we're in this like churning process, and that's going to lead to a real decline that will go on for quite some time, probably starting really in January. And the reason why I say these things is that if you look inside the stock market, and you forget about the market averages, but if you look at the sectors of the market and what stocks themselves are doing, most of the stock market is actually already in a bear market. If you watch CNBC, they'll define a bear market as something that's down 20%. Well, there's about 5,300 stocks that trade on one of the three major U.S. stock exchanges, and this is really amazing, but over half of the stocks are off or down 20%, even with the rally in October. And the majority of stocks are below their 200-day moving averages, even in the S&P 500 and in the NASDAQ. So most stocks are actually doing very poorly, and people don't really realize that's going on unless they look, because they see the market averages seem to be okay, so that hides the fact from it. And if someone owns lots of stocks and they have a brokerage account, there's a good chance, almost certain, that they're underperforming the market. They may actually be down for the year because so many stocks are down for the year. And instead of thinking, well, if something's wrong with the stock market, sadly, such people are more likely to think they're making a mistake or they're doing something wrong, when in reality, it's very difficult in a market like this to expect to just, if you're buying individual stocks, it's very difficult to just buy and be lucky enough to be in the couple of winners that are left. And those winners are things like Google, Facebook, Amazon, Netflix. It's really just about a dozen now of these big cap, high flyer stocks that are doing really well and are contributing in making the stock market go up when it does go up. But outside those stocks, everything else is performing and lagging, performing poorly or lagging the market averages.
And a lot of those, too, don't have any physical assets. What does Google really own?
Well, they've got patents and they got that campus in Los Angeles. They didn't make a lot of revenue, but the thing is, their stock is extremely overvalued if you just look at price to earnings and price to sales and so forth. Of course, it's been like that for a couple of years, but in the same story goes for Facebook and these other stocks. But that doesn't matter at the moment, but someday I do think it will.
We'll have more with Mike Swanson right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Wall Street Window's Mike Swanson. Mike, is gold going to finally turn? It's gone down in value again after a little bump. If the stock market really does start to make a major slide, will people finally turn to gold again?
Yeah, I think they definitely will. And the scenario I think is going to happen is that the Fed, it does appear, will raise rates in December. But they released Fed minutes today, and if you go by what those minutes said and a couple speeches some Fed people gave today too, they're probably only going to do it at the most 2 or 3 times if they're lucky that the stock market doesn't fall. So I don't think we're going to see very many rate hikes, and if the stock market falls, then they're going to not raise rates, and the market falls enough, they'll talk about creating a money printing program or doing something or lowering rates back down, and all this would be very bullish for gold. However, it really is going to take the stock market to fall for people to say, well, I'm going to get into gold. Just as gold has fallen over the past couple of years, and one argument people make is, well, why should I own gold because the stock market's so good? Well, that argument will end up being turned on its head. And I think gold is really going to be the big winner and big beneficiary from a declining stock market. Now, at the moment, of course, we saw gold really fall hard in July. The gold stocks were down about 10% in one day on July the 20th, and then they stabilized. It took them almost 6 weeks to do it, but they did rally, and gold rallied back up to about $11.80 an ounce. It topped out at that price at the date of the last Fed meeting and has been pulling back ever since. In fact, gold made a minor new low below the July low this morning. However, the gold stocks actually have held that low, and if you compare this recent drop over the past couple weeks to other ones we've seen in the past couple of years, it's actually been not so bad for the mining stocks. They didn't fall as much as the metal did, and that's actually a pretty constructive thing. And inside the futures market, if you look at the Commitment of Traders report, small individual traders have a very tiny short position or long position, and the commercial traders are net short about 75,000 contracts. That says of last Tuesday, so who knows, they could be 50,000 net short or even 30,000 net short at this moment as we're speaking. And historically, the commercials reduce short positions when gold is at a low or a bottom, or they have a very small short position, which they should have right now. So I really think, someone who doesn't own gold, that this is really a time to average in and buy. the thing about the financial markets is so difficult for people to buy something that they've seen drop. Even though that is actually the best time to buy it, it's scary to buy though, because if you see something drop, it does mean it can fall more, and you don't want to lose money. So the way to handle that is you just buy a small amount, put 5 or 10% of your money in, or average in, and build over a couple months or a couple weeks and so forth. People like to buy after something goes up, or so the average person is interested in buying the stock market now. They weren't interested in buying it in September, but they're interested in buying now. And with gold, they're too scared to do it. But really, now's the time to do it. And you see that, like when you see the commitment traders reports and the positions small investors have. They had over 13,000 net long position last month at the top, and now it's a small fraction of that. So it just shows you how people like to buy in the tops, and they sell out as something declines. And everyone has done that. The question people should ask themselves is to figure out a strategy to do the opposite and put it to work next year.
What is going to happen with oil? It's down to $40 a barrel, West Texas.
Well, I think we saw oil top out in the summer of last year, and it certainly had a big decline. The oil stocks, of course, really did too. Some of them completely crashed. Some of the oil stocks are actually on the verge of going under. Some of the fracking companies and so forth. In commodities, you have these bull and bear cycles, and commodities along with gold had been in a bear cycle since 2010, 2011, depending on the commodity. Oil hung in there for a couple of years, didn't really go anywhere, but then it started to dump last year. Now, what's interesting is that dump took place with a record commercial short position. So just as I was saying that gold has a very tiny commercial short position, commercials are the large hedgers, people who are, transporting oil or producing it out of the ground. They're the most important people in the market. Saudi Arabia, is the biggest commercial operator. So these guys had a record short position ahead of the start of the decline. And they've cut that position down, but it's not at a really low level. It's about halfway to where it needs to be. So I think we're probably another 12 months, even 10 to 12 months away from a really low short position in oil. Now, I think there isn't real immediate upside in oil. It's going to have its ups and downs and its rallies, but I don't think we're going to see oil really go into a bull market for at least another year. Now, that doesn't mean it has to go down, from now to then, but it's probably going to end up going sideways and basing around, and I just don't see any great opportunities there. The thing, though, about it is in the commodity cycle, usually gold and precious metals goes up first, and then other commodities, and then oil goes up last. So I think that's really what we can look forward to next year.
What about the banking sector? They seem to keep finding ways to make new money, even though there isn't a lot of money out there.
Yeah, well, that's what the Fed allows them to do by keeping the interest rates super low. But the problem is, they can borrow banks from the Fed. I mean, borrow money from the Fed itself and do all that, but they're not loaning a lot of money out. And the reason why is because there aren't that many people that want money. The economy is still very slow, and I do hear and see some people who claim that it's regulations that are burdening the banks, and if they would lighten up on it, they'd lend out more money. But I've talked to bank people where I live, and they're really hungry to lend money out, to businesses that are stable and are willing to use it. It's just they don't have customers like that asking to do it. And there's not much construction going on in most parts of the United States. So it's just what it is. It's tough right now for banks to make a lot of money because they don't have these people asking for loans, and interest rates are so low. Eventually all that'll change. Who knows when? It's really amazing, you think it's 2008 when all this stuff started, and it's been 7 years, but goodness.
Yeah, it's a long time ago, and yet it's not.
Yeah, exactly. It's quite amazing.
Mike, thanks a lot for chatting with us.
Thank you. It's good to talk with you, like always.
My guest has been Mike Swanson from WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.